Good Saturday morning to you, and welcome to On the Mark alongside Mark Pappa. I'm Gary Byron. Mark is the president of Financial Resources Group. Financial Resources Group is out of Glastonbury, Connecticut. You can find him online at www.frplan.com. F as in Frank. frplan.com. More importantly, write this phone number down, and better yet, call it. You want to call him now? Call him now. Of course, he's doing the show, so he might go to voicemail. Call him at the end of the show. Call him later today. Call him tomorrow. Call him Monday. Call him next week. Just call him and schedule yourself a consultation. Ask him how you can obtain one of those $100 gift cards, but what you're going to obtain from Mark's way surpasses a $100 gift card. He's going to set you up for life, and it's going to be probably the best phone call that you've ever made for yourself. 860-657-8380. Again, 860-657-8380. If you missed any of those points of contact, don't worry. I will repeat it at least a couple of more times before this show is over. Mark, good morning. Great to see you.
Hi, great to see you, Gary. How's everything with you?
Somewhat back to normal. I mean, we're in December now. We're Thanksgiving way behind us, heading towards the Christmas and the holiday season and New Year's and the whole nine yards. Things in my world, they slow down a little bit. I know that's not for everybody. For some, depending on your industry, retail, I know, commerce, it picks up. This is their time. They need to have a great holiday season.
Well, it'll be good to see how the economy is really doing versus what the news says. Doom and gloom and trying to make everything look horrible.
But we won't get those reports for a couple of months.
Yeah, you'll get a gauge of retail sales and figure out how things are going. You'll get some reports, and then consumer sentiments, been dipping a little bit, and but at the end of the day, a good holiday season is a good sign for strong consumers and a strong economy, and I don't think spending is gonna dip too much this year.
Well, listen, you've spent years helping folks spot and sidestep a lot of traps that are out there. What's the biggest myth that you hear from clients?
There's a lot of them, Gary. There's an awful lot of them, but let me just talk about, before we get into that, the gift cards. So what I'm doing, folks, is I'm looking for people. This is my new parameter for clients. I'm looking for people that actually want help.
Yeah.
I'm not looking for people looking for a free gift card. If you're just looking for the gift card, I'm going to smoke you out. I'll sit down with you. I'll listen to you. I'll figure out what your needs are. But I can tell whether you're there for real advice or you're there to just grab my gift card. So, be serious. I find on average for a $250,000 household, on average $3,291 in benefits people are unaware of. So that's $3,291 on average. Sometimes it's less. Oftentimes it's significantly more. That's on a $250,000 household, Gary. So now I'm only willing to work with people that have $1 million or more. Okay, if you have $1 million or more, that's who I'm really there to help. That's who I'm looking for. That's my target audience. Will I help somebody with less? Yes, if they're genuine and they're good people and they really need help, I will give you the shirt off my back. But I'm also, not a 501c3, and I'm not here to feed the public for free, and I'm not here to give away free gift cards. So this is just basically, the gift card is to compensate you for your time and effort for gathering the things that we like to look at. Things like your tax returns that we'll scrub to. We'll find hidden and unnecessary fees and unnecessary taxes you're paying. That could easily be more than $100.
Right, exactly.
How about finding a gap in your home insurance where they may not have paid for a leaky roof that you had, and they would only give you the depreciated value of the roof? How much could that be? That could be significant. That could be tens of thousands of dollars. We may find that you're paying what I'm going to talk about today, hidden and unnecessary fees in your portfolio, a thing called turnover costs, where I've been finding, just egregious amounts of fees on $1 million retirement. Forget it. It's significant. It's in the tens of thousands of dollars when, in certain cases, when you add up those turnover costs. And that's annually, Gary. So more recently, I found someone who was, paying $9,000 or $10,000. They didn't even have $1 million. $9 or $10,000. What could you do with $9,000 or $10,000? Do you want to give it to some Wall Street trading desk, or who are selling their order flow, or do you want to be able to put that money back in your pocket? So those are the things that we look for. We're going to uncover those things in our checklist review. And we do a lot of non-financial things, Gary. And the reason I do the non-financial is because do I get paid to look at people's home insurance?
Probably not.
Probably not.
No.
Or look at their power of attorney to make sure it has the correct language in it for Social Security and Medicare. Do I get paid to do those things? But I don't.
No.
But why do I still do it? Right? And the reality is because I want to be a true advisor and I want to cover all aspects of your retirement. So the gift card is not a ploy to just get you to come to my office and twist your arm to buy anything. It's actually to compensate you for the work you need to do up front to actually have this thorough review done.
The same could be said for the monthly steak dinners over at Ruth Chris Steakhouse when you would offer your 45-minute seminar. I mean, you're always going to get the Yahoo out there that's looking for a free Ruth Chris steak. Yeah. But you got probably a third of attendees are genuine in their interest in meeting with you.
Yeah, I'd say more than a third. It's just that everyone's skeptical. So a lot of the people you find at those events go to those events all the time. They're the people I call filler. They're never going to do business with me, but they fill the room. So it makes the room look, that's great. The other people there are just not sure. They're looking for good advice. They've talked to the big firms. And a lot of I've gotten some amazing people from it. A lot of the people that came on board with us were working with bigger firms. And they were like, Mark, I just feel like I'm a number. I feel like I'm just cookie cutter. I feel like their approach is just, I get the same thing as the next guy that walks through the door. And that's what we found is the case over and over again. And someone with a lot of money, I don't know what I mean a lot of money, like, let's say you're $3 to $5 million or you're $3 to $10 million client, they see that.
Yeah.
And then they can also see you're putting that in that additional effort and you're also offering things that they haven't seen before, or that are not all that common because they've been stuck in this bubble with everybody else. So we're going to talk about some of that stuff today and why working with a registered investment advisor who's fully transparent and acts in our client's best interest is going to be a little bit better than those who say they're a hybrid advisor. Oh, well, this is a fiduciary part, but this part sells commission.
Yeah.
That's just get off the fence one way or another.
With these big wealth management firms, the ones that are handling trillions, it feels like it's a rigged game. I came across this eye-opener from Financial Planning Magazine about how the largest players like Morgan Stanley and Merrill Lynch and UBS, they rake in massive revenue-sharing payments from mutual fund companies. So, Mark, break this down for our listeners. What exactly is revenue sharing? And hold on, why should it set off alarm bells?
All right. Well, Gary, absolutely. So revenue sharing is basically a thank you payment from the mutual fund giants to wealth firms for pushing their products. Think of it as a secret handshake where the fund company kicks back a slice of their profits, often, let's say, whether it could be 1/10 of 1% up to 0.30% of your assets each year in exchange for shelf space and advisor recommendations. They often... And it's dressed up as marketing support and partner fees, but it's really incentive to favor funds over others that might be cheaper or better for you. I know this to be fact because good friends of mine, I won't name names, have their own exchange-traded funds that are performing exceptionally well for our clients and very transparent, And guess what? They can't get into the big firms without knocking on the door, and you better bring a suitcase with you. You better bring a check. That's called the research fee. So, they want to make sure that their due diligence fee is covered. So it's kind of sad. And Gary, so what I did was I brought a revenue sharing disclosure from one of the major firms. They manage $9 trillion.
Wow.
Their initials are EJ. Okay.
Oh, I know what you're talking about.
All right. And so what I did was I went to their disclosures page, and you can do this at your broker-dealer or whatever firm you're working with, important disclosures. And if you're really willing to dig, and it's not an easy find because it's not something they're putting on the front page. But, EJ took in from American Fund Distributors, Inc., $124.9 million in 2024. From BlackRock LLC, they took in $8.5 million. From Eaton Vance, they took in $1.6. Franklin Templeton, $27.2. John Hancock LLC, $13.9. MFS Distributors, 39. These are millions of dollars, Gary. 39 million, 125 million, 27.7 million. And I got to ask you a question. If you were to go set up an account with EJ today, guess what the likelihood of you getting these funds is going to be? You think it's low or high, Gary?
No, it's probably non-existent.
What do you mean? The fact that they're paying why do you think American funds would pay 125 million to the firm?
You think I'll get it?
No, my point is, who do you think what fund family do you think you're going to get if they're American funds,
yeah,
right?
Sure.
If American funds is paying them to push all that money, guess what they're going to have their advisors offering?
Those funds.
Those funds, exactly. So that's the point I'm trying to make. So it's not that they're taking kickbacks on all these different funds. They're also making sure that you get those funds or you get favorable treatment. And is that fair when we have a very competitive environment and you might have a fund that's better for you, but they're going to put you in that one because they're the ones paying. They're basically paying to skip the line. Is that fair, Gary?
Of course not.
Right. So what I want to bring up to everybody on this call is I go through this with you when you sit down with me. I talk about the conflicts of interest. I talk about why you have all these different funds. And then I'll show you even this revenue sharing agreement as part of our disclosure and why it's costing you significantly more than if you just went, you went to your own exchange traded fund on your own. You don't even need. So, if you want someone to help you manage your money, that's fine. But do you want somebody, slipping them extra bucks to favor their funds?
Hell no.
All right. Exactly.
Wow. So, millions here, huh?
Yeah. So it's more because it was the article, Gary. There was two articles that really inspired me to do this show. This one from financialplanning.com. And then earlier, it was The Guardian UK did a expose on some poor college kid that got recruited to Northwestern Mutual. And it's a really good article. I posted it to my Facebook page. And it shows how they would bring these kids in out of college, promise them a big dream, promise them, give them people to call, give them phone numbers, tell them to call all their friends and family. They do a financial plan for them. And the first thing that comes up, no matter who gets the plan, according to the article, is whole life insurance. So was the most expensive life insurance out there, and that's what they're doing is they're trying to get these kids to go out and sell their friends who are graduating college and friends and family a whole life insurance policy. And it just screams of just total, utter captive business.
So you're not an advocate for whole life.
I'm not saying it's good or bad, Gary, but I'm saying if you can search the universe of life insurance, first off, it's a Northwestern policy. So if you go to Northwestern, you're getting Northwestern. They're a captive company. So yes, they have other options, down the line because they don't want to look like they're conflicted. But the bottom line is, chances are you're going to get one of their funds. If you go to work put your money at Fidelity, chances are you're going to get mostly Fidelity funds. So that's just how it works. And most people don't understand this. So that's what I'm here to try to ring the alarm bells on folks and say, do you really, really think that they're the absolute best in every single category?
Of course not.
13 different, Fidelity is going to be the best at small cap. They're going to be the best at mid cap, large cap, growth. Now, they're the best at some of the categories. So great, you can buy that fund. But does that necessarily mean that they're going to be the best at everything? Or is there someone else who could be better?
Well, how can you be the best at everything?
You can't, which is why you can't use all one company, right?
You're talking millions. And listen, Mark, that's not chump change. But how does this hit like the average Joe, like me, or the average person in Fairfield County? Are we talking like direct hits to our 401ks here? Or?
Well, it's indirect but insidious. So these payments are creating conflicts among advisors that are going to steer you to the funds with the juicy kickback. Even if a no fee, let's say a low fee or a lower fee index fund could do better. And then the SEC came out with what's called Reg BI, which is Reg Best Interest, was supposed to clean this up 3 years ago by forcing disclosures. But as the article calls it out, transparency is a bit of a joke. And again, if you want to find this form, I can actually, anyone who wants to get a copy of this form, I'm happy to share it with them, the one I downloaded from EJ's website, Edward Jones, because, the bottom line is it shows it right here. It's not that they're not disclosing it. It's just not, you have to look for it. It's not going to be on the front page of their website. Okay.
I wouldn't
but it's eating away. It's definitely hitting your bottom line. at the end of the day. Some firms like Ameriprise also, will disclose it, and then others don't say anything. So, you have, it's all the big firms doing the same thing. You again, if you're a small fry, you're a small company, you can have the best fund in the world, but if you're under a certain amount, you don't have the money to pay to get into a 401k platform, you're not getting in. You're not getting in. You're going to have to rely on some other retail channel, some other way of selling direct to getting your fund out there, but they're not letting you into the big firm without paying their way in most of the time. And that doesn't go for every single firm, but I would say most of it.
Interesting. Folks, you are listening to On the Mark along with Mark Pappa. I'm Gary Byron. Mark is the president of Financial Resources Group. They're out of Glastonbury. You can find them online at frplan.com. frplan.com. Very easy. As is their phone number, 860-657-8380. Again, 860-657-8380. I'll repeat all of those points of contact more towards the end of the show. A fiduciary. I know it's a magic word. Fee-only advisors who, kind of put you first. But, Mark, for people like that are tuning in from, let's say, Bridgeport or even Hartford, New Haven even, how do we spot the hidden fees before they actually snake in?
Well, that's a great question, Gary, because it's a good idea to know about this stuff. And again, how many advisors are actually showing this to their clients, do you think?
Nobody.
Yeah, not very little, right?
No. You're the only one I know.
Right, so that's a great question. So first off, demand a full disclosure and ask for the Form ADV Part 2A from your advisor, which we have listed on our website. It's a Form ADV Part 2A. It's fully transparent, and it should list any revenue-sharing partners and amounts. Second, you go for low-cost passive strategies like exchange-traded funds with lower expense ratios. Now, I don't always advocate. Some of the time I do. We have some funds that are paying, let's say, 0.1%. That's 10% of 1%. So 10 basis points is what they call it. So we have funds that in the model that do pay that. There's other funds that, because of the strategy, you may have to pay a little bit more. Okay, they are quantitative, or they might be structured to weight towards dividends, or then instead of a market cap weighting, it would be an earnings weighted product. That one's actually very cheap because it's been around for a long time. So others might be a value oriented, or sometimes if it's an international fund or an overseas small cap or something, the fees are going to be a little higher. So, you want to aim to have the lowest possible fees on your investments. But I'll also say, just doing the lowest possible fees on all your investments also comes typically with more risk, because those are index funds that are market cap weighted, meaning the biggest companies get the biggest slice of the pie. So if you're in a Russell 2000 vanilla index fund, it might be cheaper, but remember, 2/3 of the Russell 2000 doesn't earn any money, so you're taking on the risk that the top percentage of the Russell 2 can carry the cart for the ones that aren't earning any money. So what we do is we use an earnings weighted small cap fund that weights based on companies that are actually earning money in the Russell 2000. So you have to obviously lessen your risk, but improve your chances of success in the long run. But Gary, there's also some other things I'd like to chat about. But,
yeah, please.
Do you have any other questions for me on that?
No, go ahead.
Okay. So I want to talk about just the implications of hidden and unnecessary fees, just because it's something that is near and dear to me when we do our financial reviews. One of the things I know I mentioned earlier, I might have talked about turnover costs, Gary. Mm-hmm. And again, it's just such an ugly fee, just because it shows how often each of the managers are trading inside your account. So sometimes, in the best performing funds, the ones in the top 95% quartiles, do you think they had low turnover or high turnover?
Yeah.
It was low.
Yeah.
You know why? They were buy and hold. Mm-hmm. So when we're trained how to invest, Gary, were you trained to be buy and hold, or were you told to be a day trader?
I've been told different things from different people. Right.
But what do you think? Which one do you think does, the people who trade a lot, or the people who are more like Warren Buffett? Who makes the most money?
I mean, Warren Buffett is probably the model that you should be looking at.
Yes, exactly. So it's more of a Warren Buffett type of thing. So what we do is we sit down with folks and we explain this thing called turnover costs. And then what it does, I mean, you have the more that if they trade 0, then you have 0 turnover costs. If you have 100, well, then that means they turn the portfolio over 100%, right? So the portfolio started with 100 stocks, and they sold 100 stocks, and they sold those 100 stocks and bought a new 100 stocks. So my question to you is, if that stock was 100 stocks were good at the beginning of the year, you mean to tell me by the end of the year all 100 aren't good? So what you have are these managers that are trying to beat the market with trades showing a profit. The problem is that you have commissions, you have market timing, right? Trying to get out of that trade. There's a cost with that because you're doing big blocks of trades. And you also have another cost for clients that are not in Roth IRAs or IRAs. You have this thing called taxes, Gary, right? Are you familiar with taxes?
I've heard of them, yeah.
Yeah. Long-term, you have long-term capital gains, and you have short-term capital gains. So the problem, Gary, is if they're trading all these stocks, 100 stocks, within a 12-month period. So short-term is if I'm trading and I buy a stock on January 1st and I sell it in April 15th for a profit, that's a short-term gain. Oh. Now, if I wait an entire year and a day and I sell it, that's a long-term gain. But if these guys are trading willy-nilly throughout the course of a year, guess what's happening to my tax bill? Right? It's going up.
Yeah.
So not only that, if it's short-term capital gains, you're paying at your ordinary income rate. So let's say you have a married couple making, let's just call it $200,000 with a couple kids, and they have a brokerage account, and they have this fund in there, and they, without knowing that they might have got the fund from grandpa or whatever, and when they turned 18, turned it over to them, and now they don't realize that inside that fund there's all this trading going on, and then they get what's called a capital gain on their taxes, and they're like, but we didn't buy or sell any stocks. What happens is they pass those taxes on to you, the consumer, Gary, not them. So you end up having to pay those. And it's just, it's sad. And most people just assume, oh, that's the norm. Well, let me go with the flow. But the reality is it can be prevented. And again, that's what the full checklist review will do, is go in and scrub and see where are those hidden and unnecessary fees. How much are you going to be paying in additional taxes? How do we eliminate that problem? And it's a very easy fix, easy peasy to fix. It's just a matter of just thinking a little bit differently, being smart, and choosing the right type of vehicles for your investments. And that's basically it. And then I would also say on your, that there's some other kind of things that we like to talk about as well, which is through Morningstar. So this data, Gary, that I put together, it's not my data. So if it was my software, it was Mark Pappa's analytical software, how believable would it be?
Be a little biased?
A little biased, exactly. So so the whole idea is we want to take a look at some other things that we like to look at. One of them is a risk versus reward scatter plot. And in the long term, let me put it this way. It's like an X-ray on your account. It's an X-ray for mutual funds. And I'm not going to describe what it looks like, but basically what it does is it basically takes the guts of the mutual fund, and it shows you where on the scatter plot where your fund is performed versus the market. A lot of times we realize they have a quartile that says low risk, low reward. Then they have high risk, low reward, high risk, high reward, and low risk, high reward. And what we find often, way too often, is people are taking way more risk. And guess what happens on the reward side? Not getting the reward. So they're paying managers a fee to beat an index fund, which you can get for next to nothing. And they're paying these managers, and these managers are not only trading willy-nilly, costing them money in that trading costs, turnover costs, and all these other expenses, management fees, but yet they're not even coming close to beating the market or even their own benchmark. So the S&P 500 itself, Gary, is a benchmark. Right? There's 500 stocks. That's the benchmark. There's other benchmarks. There's an international index called the MSCI AQUI. That's a benchmark. There's the Russell 2000. That's a benchmark for small caps. So what we do is we say, if you have a fund that's a small cap fund, it's not beating it's not beating the Russell 2000. You got a problem. You're paying a manager a fee to beat that index. Why? Otherwise, just own the index. Right? What would you rather do? The index is doing better. Most of the time, we find that the managers can't possibly beat the index, and especially beat the market. And anyone who does beat the market, what we find within a couple years, they can't beat the market anymore. So no one can consistently do it. So what we do is we do our best to say, let's get as close to the index return as possible. If not, try and beat it once in a while, but not do anything stupid. You don't need to take outside risk to do it. You just need to be smartly diversified and keep yourself in the game, and have make sure you're subject to too much volatility or risk isn't concentrated. And then the third thing is, the final thing I want to bring up is correlation. And in correlation is we're going to ask and see how much alike are all our investments. And Gary, I just did a case the other day where I think the average fund was about 75% correlated.
Oh.
Yeah, 75%. Oh. So that means if you had $10,000 and the market dropped 10%, right? You would be $9,000. But that means that a huge chunk of those funds would also come down. Maybe not 10%, but it would come down significantly because it's 0.75 correlated. So we look at the correlation and we realize that a lot of people's accounts aren't diversified at all. So we want to make sure not only are you not diversified, but ask you why you're not diversified, get you to come on board with us and show you how to actually do that for real.
How can somebody just get on board with you? It's a process, I would imagine.
It's an easy process. Come in.
A few seconds here.
We've got a goals meeting for about a half hour to 45 minutes. We're going to go over your goals. The meeting's all about you, not about us. We're going to gather some data. Once we have the data, we'll have you in for the full checklist review.
That's the second meeting.
Second meeting. It's a couple hours of just going through non-financial things, housekeeping things, and then you're making sure that obviously the money part is important. But usually what we'll find is, your beneficiaries might be titled incorrectly. You might disinherit grandkids potentially. Your money will go to probate because it's not titled right. So those are the little things we like to cover. But then when we get to the money and we expose the fees, that's a game changer for most people.
All right. Well, then let's get the ball rolling. You can meet with Mark very easily. Very easy. I would say head on over to his website, over at Financial Resources Group. He's got an office in Glastonbury. Online at frplan.com. F as in Frank. frplan.com. And call him. In fact, the show's nearly over. You can call him right now. 860-657-8380. One more time. 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.